The most important session in entire JAIIB syllabus. Why? Because we'll be studying futures and options today. Now, our session is packed. Futures and options, meaning and numericals on options. Now, these numericals do come to you in exam for 5 marks case study. So, remember, this is a very difficult part and follow this video till the end. I'll make it as simple as peanuts. Okay. Before that, download Adda 24/7 app on your mobile. Also join our Officers Adda 24/7 YouTube channel. On this app, you'll get the various updates of banking exams, various JIB, CIB material, video lectures, live classes, tests, you name it, you have it related to banking and finance. Okay, so join this, download this app as fast as you can. Let's move on to the topic. Okay, before that, this batch of case studies, it's presently running from June 20th. We are now in ABM batch. Remember, from Monday we are starting with the BFM batch for 7 days. Remember, this is the last minute revision. 12 into 5 marks. Okay, means 60 marks case studies you will get it in this BFM. Also ABM is running, but ABM is almost covered now. Okay, so go for this BFM batch as fast as possible. Okay, yeah, let's move on. Yeah, this is a new batch which is coming up, just to remind you. Okay, this is a new batch for December 22 exam which is coming in. So use this code, also join this batch as fast as possible. With this code you'll get a discount, means it's a raining of discounts. Okay, so go for this and use this code. Okay, let's start with the topic without wasting much time. Okay, futures and options, meaning. Understand what do you mean by futures and options? Okay, I'll tell you one simple logic over here. Okay, regarding options I'll tell you, that's easier to understand. Okay, suppose let's say you want to buy a flat. Okay, what do you do? How do you buy a flat? You give some initial amount to that builder or that developer, right? And then remaining amount you give it in installments. That's the basic logic. Okay, now how do you buy a plot? Plot means open plot. Do you have any builder or any developer over there? No. What do? You prepare an agreement to sell, right? Agreement to sell means just somebody is agreeing and you pay him some initial amount, some token amount, right? And what do you agree? After 3 months or whatever that period you agree, you will be paying him the remaining amount. Okay, now what happens within that meantime, within these 3 months? Okay, the value of that plot, suppose let's say you give 10,000 to somebody and the plot is of let's say 1 lakh. Okay, within 3 months what happens? And you make the agreement. Now within 3 months what happens? The value of that plot, okay, or that land goes down drastically. Something happens over there, some road goes from there or something happens, and the value of that plot goes down from 1 lakh to 50,000. So you have made a contract with that guy, means you have made a contract to buy, you have paid him initial amount. What will you do? Will you go to him and tell him, okay, I have made a contract with you for 1 lakh. So what do we do? What do we do is sell me the plot for 1 lakh. Now the value of that plot is what? 50,000. Will you go there? No, you definitely won't go there. What will you say? To hell with my 10,000 rupees. Let my 10,000 rupees go to the well, to the sea, in the river. Okay, I don't care, but I'll save at least my remaining amount, right? That's the way option functions. Means you have a right to buy that plot, but you don't have the obligation. What's lost? Your minimum amount. Now let me consider the reverse case. The value of that plot becomes from 1 lakh within 3 months. It becomes let's say 1.5 lakhs. Something happens, some government policy comes in, something comes in and it becomes 1.5 lakhs. What will you do? You will be the first person to run to that seller and tell him, see this was a contract. So sell me at any cost, okay? Because we entered into the contract. Now what happens is it becomes the obligation of that seller to sell you. Remember, now here comes the point of options. The option buyer means when you buy the plot, you give him the token amount. The buyer has a right but not the obligation to buy that plot or buy that option. But the seller has an obligation to sell that contract or sell that option. Okay, that is the difference between buyer and seller. Now I think you might have understood this concept of options. Okay, okay, type yes if you have understood it. Type yes fast, because I want you to understand this. Okay, Type yes if you have understood this. Fast, 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 fast. Yes, 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 yes. Type fast. Yeah. Okay. Okay. Now got it. So you all have understood by now the options meaning. Okay. I'll explain the technical terms. Not an issue. Second is futures. Okay. What do you mean by futures? Here, the same example of plot. When you make the contract of 10,000, means paid that 10,000 initial amount. So what are you doing actually? You are applying futures contract over there. Means you are booking that plot for you. Same thing happens in shares also. Suppose Reliance futures, Reliance stock. Okay. I want to buy, let's say the Reliance stock is presently at what? 2400 average. Okay. So if I pay 600 to that stock exchange, I book that Reliance share. Okay. But I don't buy that Reliance share right now. I get the right to buy that Reliance share. Okay. That's the meaning. Same thing about plot. When I give you 10,000, I book that plot. So I get a right to buy that plot after 3 months. But if I want that my 10,000 shouldn't be lost, so I need to buy that, pay you the remaining amount and buy that plot, right? Same thing over here. Reliance futures, same logic. Okay. So coming back, an options contract gives an investor the right but not the obligation to buy or sell the shares at a specific price at any time as long as the contract is in effect. So option buyer will always have a right but not the compulsion to do the exercise the contract. Okay. Whereas in futures, a contract buyer requires to buy the buyer to purchase the share or seller to sell them. Means either of these two. It can be any of these on a specific future date unless the holder's position is closed before the expiration date. Means if the plot, suppose take the same example of plot. Okay. I tell you I'll buy that plot after 3 months by paying 90,000. But beforehand, in 1 month only I get amount. So I'll pay you 90,000 and close the contract. Okay. Same thing. Same thing happens in this futures options futures contract also. Got this point? So yeah, you'll understand this better from this example. Understand this. Any options buyer, let it be call option or put option. Okay. Any option buyer will always pay the premium. Concept should be cleared. Option buyer will pay the premium. Option seller will always receive the premium. It's like that insurance company. Okay. See here, bike insurance. You buy the bike insurance, you pay the premium to that insurance company. If something doesn't happen, let's say something happens to your bike, you run to that insurance company, see, pay me the losses, done. Now, if nothing happens to that bike, what happens? Your premium is gone. Insurance company won't pay you anything. Same thing happens with these options also. Okay. So, you pay the premium to this insurance company. In options also, you pay the premium. But if the strike price doesn't come in, then your option is, this premium is gone. Only the loss is your premium. Okay. So, got this point? Option buyer will always pay the premium. Option seller will always receive the premium. Okay. Now, if you want to safeguard your position, stock position means what? See here, I'll explain you over here. What do you mean by safeguard the position? One important point comes over here. That is, let's say this. Okay. Let's say I buy a Reliance share. Okay. Means let's say I buy a Reliance share at 2400. Okay. I expect the share to go to, let's say, 2600. Okay. That's why I'm buying. Why am I buying that share? So that the price goes up and I earn something. Okay. Now what happens? Instead of 2400 going to 2600, this stock goes down. It goes to 2200. Then what happens? I'm at loss. So here the picture of option comes in. Suppose if I want, I expect that the stock price to go above, but it goes down. So prevent this loss. To prevent this loss, I'll buy the option. So which option will I buy here? This position, buying the stock at 2400 and expecting it to go to 2600, is known as a long position. Long. Okay. So whenever I am in a long position, remember, this, I'll always buy the put option. Put option. Okay. So for any long position, I'll buy the put option. Now what is the second position then? It's called a short position. Means I sell the stock of Reliance at 2400 expecting it to go to 2200. So this is known as short selling. So this position is known as short. Okay. So whenever I have any short position, I'll buy the reverse option. That option is known as call option. Okay. Understand this. Whenever you are in a long position in stocks, you'll buy a put option. Whenever you are in a short position in stocks, you'll buy a call option. Understand this. This question comes to you in exam for call and put options. Okay. Next point. Beforehand, say this again. I am telling you, BFM is starting from 27th June Monday. Join this as fast as you can, because only 1 week, 12 case studies, 5 marks each, 60 marks. You clear BFM. That's it. What is required? We cover all the case studies over there. So join as fast as possible. Okay. Also the other batch which I told you, this batch, this December batch. If you are planning for a long term, join this December batch coming up. Okay. You'll get a discounts. I'll show you how to get the discounts. Okay, using this code Y432. Okay. Let's move on. Now let's go to the problems. Numerical. Okay. You make a contract with the insurance company, or let's say seller over here, not an insurance company. We'll say a seller. Okay. That they will buy the stock from you at rupees 40 from you, if and when you wish to sell them within 3 months. So you make a contract with them. Yeah, he is a buyer now. Okay, he becomes a buyer because you are selling the contract, the share. So he becomes a buyer now. Okay, so you make a contract with this insurance company or the buyer that he'll buy from you at rupees 40 within 3 months. Okay, now understand the various cases. You pay a premium of rupees 3 to him. Remember, in this option market, even though you are selling, but then also the premium over here is given by you in this case. Why? Because this buyer is taking a risk that he'll buy the stock at 40 from you. So that's why to cover that risk, you pay a premium of rupees 3. Okay, dollar, rupees, say anything. Okay. So even when the stock price falls to 30, you wish to exercise the contract. Now I'll tell you one simple example over here. Let me see if we are having the space here. Okay, I'll give you one simple example. See here, always remember in this options market and future market, okay, there are only 3 players. Always remember, there are 3 players only. Who are the 3 players? First, you. You means you who are the buyer or seller. Firstly, let's consider you are the seller. Okay, in this case only, you are the seller of that stock, right? Seller. Okay. Second person is this other guy. Let's say B. This person. Okay. This B is what? He is the buyer. And we have entered into a contract. Now me and this guy have entered into a contract to buy at 40. Okay. Let's say presently the stock rate is 30. Okay. Now there's a third person involved over here, that is known as market. This market is not actually a person. It's a whole market going up and down. Okay. Now what happens? Let's say case number 1. Okay. In case number 1, let's say your price presently for the stock is 30 rupees. Okay. And if this price goes to, let's say, 35 rupees. Okay. So what will happen? Will you go to this buyer and tell him that, okay, buy it for rupees 40 at me because we have entered into a contract? Now what has happened? Listen, 30 rupees was the present price. After 3 months in the market, the price has gone to 35. So will you go to this buyer and say that, yes, exercise the contract at 40? Type yes or no. Fast. Type yes or no. Type yes or no fast. Yes, correct. You will definitely go, because your market price, see this, I am telling you, I'll write it over here. Market, I'll write M for over here. And what is the buyer price? 40. So who is higher? Buyer is higher. So definitely I'll make the contract with the buyer only. I'll sell it to the buyer, right? Now let's consider the second case. Okay, 30 is the price. Okay, and what happens? The market price is now 55. Okay, market. And buyer's price, what have I contracted? 40. Okay, now what happens? Will I go to this buyer again? From price is 30. After 3 months, market becomes 55, and this guy is having, we have contracted with him at 40. So will I go to this B to buy this at 40, or will I leave this? Forget him. I'll buy in this. I'll sell in the market. Okay, what will you do? Type yes. Type M or B. Whom will you go to? M or B? Type fast. M or B. M or B in this case. Okay, M or B. Will you go to M or will you go to B to sell that stock which is at 55 in the market and you have a contract of 40? Yes, you'll go to M. Why will you make a loss of 15 rupees? You'll sell it in the market, right? Now let's consider third case, because you need to understand this concept. Let's say the stock price is 30 now. You have made a contract with this B, okay, at 40. Okay, this is B guy. Okay, and now in the market price, in market, the price becomes what? Let's say it becomes 20 rupees. It goes down. Instead of going up, it goes down. So what will you do now? This is the market price now. So again put the logic, who is higher? Who is higher? Okay, so who is higher over here? Buyer. So definitely you'll make a contract with buyer. Okay, so understand the concept first. In if the market price is higher, nobody will go to the buyer to sell it. Okay, if the market price is lower, let it be profit or let it be loss, okay, then anyone will go to the buyer. So that is the beauty of options. Okay, now this is the case given over here. Now what is the premium I have paid? 3 rupees. Okay, so what is my total outgo? Suppose let's say the stock price is at comes at 40, means I'll exercise the contract after 3 months with this guy B only. What happens? What is my total money out? 30 rupees for that stock and 3 rupees for that premium, this premium which I have paid. So total out is 33. What is in for me? Money in. So sale to that company is at 40, right? So I'll earn how much? 40 is my selling price, 33 is my cost price, so 7 rupees I'll earn, right? On one stock. If I have 100 stocks, I'll earn 700. If I have 1000 stocks, 7000, right? Lakh stocks, lakh. Okay, that is the way it is done. Okay, now consider one more case, the same case. Okay, stock price 30, there is 40. Okay, now if the price goes to 20, okay, will I be at a loss or profit? Let's say, let's consider this case. What is the maximum gain to the investor? What can be the gain to this guy? See here, look at these three cases. Okay, now the market price can go to 55, it can go to 100, it can go to 1000, it can go to 10,000, anything it can go to, right? So what is the maximum gain which I can get? Maximum gain which I can get is this market price, right? So unlimited. I'll get an unlimited gain because I don't know where the price will move on, right? Do you understand this? Type yes if you have understood this. What is the maximum gain to the investor? Type yes. Have you understood it? Right? You don't have the obligation to sell it to the insurance company or that buyer. Okay, if the stock goes up beyond 40, then you'll keep the stock and sell it wherever you want at a higher price. Okay, what is the amount you are losing in this? See, this premium which you have paid to this insurance company or to this buyer, you lose that much only, right? Second, if XYZ stock drops to rupees 25, the investor, so what will that investor do? Forget, let's consider this question at 25 only. XYZ stock drops to 25. I had bought it at 30. What will I do? I'll follow these three cases only. Okay, this stock has fallen down. What will I do? Will I sell it in loss? No, I'll go to this guy, right? See, buy, this was a contract with you, buy this at 40. So again I'll earn rupees 7. Even though the stock has fallen down, then also I'll earn. Why? Because I made a contract with this guy, right? So that is the meaning of this. That is the beauty of this options and futures. Even futures, you have the same thing. Whenever you enter this contract with this other person, he has, see here, only the difference between future and option is option buyer has a right but not the obligation. But future buyer or seller, both the parties in future, they have the obligation. Okay, that is the only difference. Okay, got this point? Okay, next one. Now, yeah, what is the break-even point in this case? Let me ask you one question which is not there over here. BEP, what is the break-even point? Break-even point means what? No profit, no loss. What is the BEP over here? See this. Who can tell me? Write fast the answer. What is the BEP for this person? Break-even point. Okay. Who is the, means let's say me only. I am the buyer. Means I am the seller. So what is the break-even point at which I'll not earn anything, not lose anything? Correct. 33, because this is the price I have paid and this is the premium I have paid. Now if the stock goes to 33, I'll earn nothing, I'll lose nothing, because whatever is gone is received by me. Whatever this stock goes above 33 at any price, that's a profit for me. Okay, so understand the range now. If the stock goes below 30, I'll definitely sell it at 40 to this guy. If the stock or any commodity, if the stock goes from 30 to 40, any range, then also I'll sell it to him only, because it is less than 40. Until and unless this price is less than 40, I'll always run to this contract guy B, right? If the strike price, if the price goes above 40, then I will neglect this guy and sell it in the market. Okay, that's the basic logic of options. Okay. Second one, a customer has bought 100 shares of XYZ stock at rupees 30. The stock has appreciated to rupees 40 in the past 8 months. The investor is confident that the stock has an upside potential but is concerned with the near term weakness in the overall market that could wipe out his unrealized gains. Means he knows this stock will go to 40. Presently he has bought it at 30. But he wants to cover this short term losses which might happen. Let's say this, okay? 30. I'm at 30 and expecting it to go to 40. Okay, so this position is called as what? Long, right? So I'm getting a long position. But what can happen? This stock can go to lesser part also, 25 also, 20 also. So I want to cover this position. I don't want to bear this loss. So what should I buy in that case? Which option should I buy? Call or put, type fast, A, B, C or D? What will you recommend? First is, will you recommend bear the loss? If anything goes down, bear the loss. Then what's your use? We as a banker must guide the customers. Okay. So will you say bear the loss? No. Will you say buy the calls? No. Will you say sell puts or will you say buy puts? What will you say in that case? Tell me write down fast, A, B, C or D. Okay. You'll always suggest him to buy. Tick tick 1, tick tick 2, tick tick 3, tick tick 4 and tick tick 5. Done? Yes. Type fast. You'll A, B, C or D. Correct. You'll suggest option D, buy puts. Okay. Put should be the buying strategy. Always. What did I tell you earlier? For anything, here. Where was it? I suggested you, whenever you are in a long position, always buy put. Whenever you are in a short position, where was it? It was somewhere over here. Yeah. See this. Whenever you are in a long position, buy put. Whenever you are in a short position, buy call. Keep this logic very clear about it. Okay. So you'll suggest him to buy put, option D. Okay. Everyone has understood this logic. Has everyone understood this problem also? Because remember, you will get a case study for 5 marks on this. Roughly 2 case studies we get. Okay. So before going now, use this code Y432. How to use this code? I'll tell you. See this. Let's go for an example. I'll show you with the new series which is coming up. Go to Adda 24/7. Okay. One sec. Let me bring this. Show you live over here. Yeah. See here. Go to Adda 24/7. Here you go, you come over here, JAIIB and CAIIB. See this. Click on this JAIIB and CAIIB page. Once you click on this, you'll see all the products, various products. Okay, click on all various, view all JAIIB and CAIIB products. See, once you click on this, see this, you'll get all the batches. These batches, click on any of the batch. See this 17999. Okay, go with this batch. Click on this. See this. You'll see all the highlights over here. 150 hours of live two-way interactive classes, topic-wise free full mock tests and ebooks, detailed subject-wise expertise, recorded 24/7 videos. What else do you want? Okay, this much study for 1 hour or for 1.5 hours or 2 hours is enough for you. Okay. Also, now the fees 1799 is the fees. View the offers. Click on view offers. Now see the magic of the code. Use the code. What is the code I told you? Type in the comment section. What was the code? Why? Fast 432, right? Apply. See the fees. Now the fees is 80% off. See, grab it as fast as possible, because this is 80% off. 1799 has reduced to 3599. Means 3599 is the fees which you'll be paying for this full batch of, means roughly 2 months batch, 6 months batch roughly. Okay, so you'll be paying for only 3600 on an average, 3599. Okay, now this 3599, when you clear this ABM, BFM and retail CAIIB, when you clear it, what is the increment roughly? You get roughly 1200 to 1300 rupees increment per month. In how many months will you recover? Even if you consider the least 1200, 12 3s are 36. In 3 months you will recover everything. Whatever remains later, whatever you receive later is what? Throughout your life, it's your profit. So go for it as fast as possible. I'll see you tomorrow with another topic. Bye.